Understanding the break-even point is like having a GPS for your business journey. It's that crucial moment when your total revenue matches your total costs. No profit, no loss. Think of it as the line in the sand that tells you, this is where I need to be to keep my head above water. If you're a business owner or someone thinking about starting a venture, grasping this concept is essential. It's not just a number, it's a vital tool that shapes your decisions on pricing, production, and overall financial health. So what exactly is the break-even point? Simply put, it's the point at which your sales cover all your costs. To calculate it, you can use a straightforward formula. Divide your fixed costs by the difference between your selling price per unit and your variable costs per unit. Sounds simple, right? But let's break it down further to understand its significance. Fixed costs are those expenses that don't change regardless of how much you produce. Think of rent, salaries, or insurance. These are the bills you have to pay, whether you sell 1 cupcake or 1,000. On the flip side, we have variable costs. These are the expenses that fluctuate based on your production level. For example, if you're running a bakery, your costs for ingredients like flour and sugar are variable. The more cupcakes you bake, the more you spend on these materials. Now, let's dive into an example to see how this all works in practice. Picture a small bakery that has fixed costs of $2,000 a month. Each cupcake sells for $3, and the variable cost to make 1 cupcake is $1. Using our break-even formula, we find that the bakery needs to sell 1,000 cupcakes to break even. If they sell fewer than that, they're operating at a loss. If they sell more, they start making a profit. Now, why is knowing your break-even point so important? First, it gives you clarity on the minimum sales you need to stay afloat. This insight is crucial for budgeting and financial planning. It helps you set realistic sales targets and make informed decisions about pricing and production levels. Second, understanding your break-even point can help you evaluate the profitability of different products or services. If you have multiple offerings, you can compare their break-even points and focus your resources on the most profitable ones. Third, it plays a significant role in pricing decisions. Knowing your break-even point allows you to determine the minimum price at which you can sell your products without losing money. This way, you can set competitive prices that still ensure profitability. But it's not just about knowing the break-even point. You also need to be aware of the factors that can affect it. For instance, if your fixed costs increase, say you move to a more expensive location, your break-even point will go up. Similarly, if your variable costs rise, you'll need to sell more units to cover those costs. On the other hand, if you can increase your selling price, you can lower your break-even point, which is always a good strategy. Now, let's talk about some common mistakes businesses make when calculating their break-even point. One major error is misidentifying fixed and variable costs. It's crucial to accurately categorize your expenses because if you mix them up, your calculations will be off. Another mistake is failing to include all costs. Overlooking even a small expense can skew your break-even point, leading to poor financial decisions. And what about technology and automation? These can significantly impact your break-even point and overall profitability. By automating certain processes, you can reduce labor costs, improve efficiency, and ultimately lower your break-even point. For instance, a bakery that invests in automated baking equipment can produce more cupcakes in less time, reducing the variable cost per cupcake and allowing for a lower break-even point. So, who can benefit from knowing the break-even point? Business owners, managers, investors, and even lenders can all gain valuable insights from this information. For business owners, it helps in making informed decisions about pricing and cost management. Managers can identify inefficiencies and optimize operations. Investors can evaluate the financial health of a company, and lenders can assess the creditworthiness of a business. Now, when should you focus on reducing your break-even point instead of maximizing profits? During the startup phase, for example, it's often more beneficial to establish a low break-even point to give your business a solid foundation. In competitive markets, Lowering your break-even point can allow you to offer better pricing without sacrificing profitability. Similarly, during economic downturns, focusing on reducing costs can help maintain stability. In conclusion, the break-even point is more than just a number. It's a fundamental concept that every business owner should understand. It guides your pricing strategies, helps you manage costs, and ultimately shapes your financial health. Whether you're running a bakery, a tech startup, or any other business, knowing your break-even point is essential for success. So take the time to calculate it, understand it, and use it as a tool to navigate your business journey. With this knowledge, you'll be better equipped to make informed decisions, maximize profits, and achieve your entrepreneurial dreams.